Hello YouTube, this is Steven with On My Way to Fire, personal finance channel about early retirement and all things investing. And in today's topic, I want to talk about the case for small cap and mid cap mutual fund stock indexes. And this is a big topic for me because in my early days of investing, when I think of the market and I hear about people saying, oh, that market's on fire, market's doing really well, I didn't really know what that meant. And there's so many different markets that it's kind of confusing to a new investor. So I want to break down some information and hopefully this helps you. And if you get anything out of it, please give me a like and subscribe. I'd appreciate it. If you have any comments to make, please also add that so we can engage in a discussion and talk about this. All right, so let's get to it. So I did some research through Google, ChatGPT, and doing some back testing to give you some actual numbers and compare it to my performance. And again, this is all going to be relative to my situation. If you've invested in these funds or are considering it, do your own research. I'm not an investment advisor, but this is just some comparison just to give you some information on how a real life investing journey has gone. So let's give some information. When we think of the market, it's probably referring to the S&P 500, and that's the biggest 500 companies that are in that fund. And they tend to be weighted, meaning that the bigger companies have a higher position in terms of the percentage. It's not equal for the most part. And this is something new that I just learned in doing some research for this video, is that for the most part, they are weighted index funds, which is kind of interesting. You have to go out of your way to find a non-weighted fund where there's actual equal allocation between all the companies. So that means big companies like Apple, Amazon, Google, Nvidia, they have a higher sway in how the S&P performs relative to their performance. So it's actually pretty interesting. And since they're doing so well, it actually works out pretty good that they are the leaders in those funds. All right, so let's get to it here. S&P 500, that's the broader market overall. Then you have the NASDAQ, that's more technology based. And then you have the small cap and mid cap funds. Small cap are companies that are under $2 billion in value. And these are basically up and coming companies. For the most part, they don't issue dividends and they're a bit of a crapshoot. So it's a higher risk for higher return, higher reward. Mid cap kind of occupies more of a middle ground, and these are more established or maybe higher capitalization companies, but they aren't quite small cap anymore. They've graduated to that next step. And that could be considered a sweet spot in terms of investing because you get a little bit of potential for growth, more so than a large cap company, but you don't have as much risk as a small cap. So they tend to return a little bit less than small cap. But let's give some real examples here of what I looked up. And bear with me, I wrote this down so I would have some actual information. So far for this year, the S&P 500 is at a 7% return. The mid cap index is about a 3% return, and the small cap is 2.5%. And I based this on a hypothetical $10,000 invested in these different funds on January 1st. How much would they be worth? So that $10,000 for the S&P would be worth $10,780. Mid cap would be worth $10,300, and the small cap would be worth $10,250. But let's keep some things in mind. For the most part, a lot of us are investing in our 401k. We're investing installment amounts. Okay, this is based off our paycheck, and so if your amount comes out to $300 or $400 per check, whatever that amount is, it's split up amongst different things. And so a lot of people generally just invest in the S&P 500, and that's fine and dandy. That's going to give you broad exposure to many different companies. But we're going to do some comparison here to show you the difference as far as what a starting value at the beginning of a year can give you versus what paycheck contributions and what's called dollar cost averaging can return. And it's actually quite eye-opening for me because I see these numbers published, but yet I have different results. So it's pretty interesting. All right, so let's do a 10-year look back. If you invested $10,000 in the S&P 500 in January of 2015, it would return 11.5% for a total amount of $31,000. That's pretty amazing. Small cap returned 9.05%. And that same $10,000 would be worth about $24,000. Mid cap returned 9.95% compounded would give you $27,000. So it's basically saying S&P 500 had the best return rate at 11.5, Small cap, the worst at 9.05. But I don't think that tells the whole story, because depending on how much you invest and your frequency of dollar cost averaging, you can actually outperform these numbers, because that's assuming that you dumped in $10,000 at one time. Generally, that is not how most people invest. They are dollar cost averaging throughout the year, and that's powerful. I was blown away. So let's give, for my performance, let's go year to date. They say that the S&P has returned 7.8. Well, the equivalent fund that I have has only returned 5.5%. So it actually underperformed based off dollar cost averaging. But here's where I outshined. Mid cap returned 3% year to date if you did the $10,000 at the very beginning of the year. But because I'm dollar cost averaging, I have a return of 12.7% in the mid cap fund that I have. Small cap, had I done 10,000 at the beginning of the year, 2.5% return as of May 8th closing. Well, mine, 16% return for small cap. That is quite a difference between 2.5% as a lump sum starting point year to date versus dollar cost averaging 16%. Huge. Okay, let's go and be a little bit more drastic, and let's look back to last year. We had Liberation Day. That caused the markets to go down quite a bit. And instead of panicking, I saw it as an opportunity. I had cash in stable value and long-term bond funds, and I deployed it. I can't remember the exact amount, but I did at least 3 or 4 transfers into small and mid cap, as well as company stock at the time. And here's the performance for 2025 to date. So that's going to include all prior money that I had in these funds for all these years since 2014, in addition to new investments for current paychecks as I'm depositing. 2025 to date, my S&P fund is up 27.5%. Pretty amazing. Small cap, 40.5%, and mid cap, 28.5%. That is an unbelievable, numbers on these returns. And a lot of it does have to do, I think, with my position of being moderately aggressive when I see things going down. I am not panicking, and I'm taking it as an opportunity to buy into these funds during the dips. Now, this doesn't always work so quickly. Sometimes you're in a prolonged down period where these stocks stay down for a while, but you have new paycheck contributions coming in to dollar cost average into these funds, and you're picking up shares cheap along the way. Eventually, you get a market rebound, and all of a sudden everybody's euphoric in the financial media talking about how, these funds are doing so great. But generally they end up talking year-to-date returns, and they don't give a realistic perspective on how dollar cost averaging can actually be a huge benefit to the average investor. So I'm considered what's called a retail investor, just a regular person investing in the market. You have institutional investors that are more, like a portfolio manager, or even like a, certain fund, what would you call like a hedge fund that people pay extra money to. Those kind of people don't generally invest in index markets. They're usually stock pickers. But for the purposes of what I'm talking about here, an institutional investor is going to be somebody who has millions and millions, hundreds of millions of dollars to invest on behalf of many clients. But I just wanted to draw a big distinction, because if what it's telling me that small cap averages about 9% and mid cap averages just below 10% for that 10-year time period, you can have other time periods that perform better or less. And in my case, small cap for this year and a half has outperformed that average by a significant amount, by 4 times. Mid cap has outperformed by almost 3 times. And so my takeaway with all of this is that your individual situation will vary. Sometimes you'll get lucky based off market timing, sometimes you won't. But it's the fact that you're consistently investing over a period of time and putting in being the market essentially. You are not trying to time it with a lump sum that you can have amazing returns. And what ends up happening that I see is the market tends to set like a new floor. So as far as mid cap and small cap, I haven't looked at the numbers exactly, but when they go down, they don't tend to go down to like what they were in 2015. They're continually growing year after year. And even if you have a down year, it comes back. And maybe it only has a 3 or 4% return for the entire year. But that's not the whole story, because you were buying throughout the year on your paycheck contributions. So I just want to thank you for stopping by, checking out my channel. hearing some real life comparison to what actually is purported in published information. You know, if you look at these funds and you're thinking about getting into them, you're looking at a prospectus which gives you a year to date and a 10-year window, kind of like this lump sum investing. So it doesn't quite tell the whole story. So thanks again, and we'll see you in the next video.